We have been discussing about big tech here, and there has been some increasing discussion as of late about the B word, the bubble word, right? And it seems as though the bulk of strategists are coming out and saying this is not a bubble. We're not there yet, that they're not seeing those characteristics. How are you thinking about tech and whether we're there?
Good afternoon, Julie and Josh. It's great to be here. Congratulations on your new show. Very exciting. First things first, I think that, we think broadly about the growth and quality space. So, as you and I have discussed before, obviously AI is huge. It's a mega trend that we are focusing on, but really investors are much more thoughtful around adding quality in their portfolio. So that's what we have seen garner a tremendous amount of inflows. And again, when we talk about quality, what we do mean is some of those characteristics that AI companies tend to have, which is very strong and stable earnings, which is low leverage, which is a lot of excess cash flows. And I think all of those are in vogue now. I think even in a world where the Fed, and this is not the base case, but even if we can envision a world where the Fed probably just goes a few less times than what is priced in the market right now, I think that still bodes well for the quality as well as the large cap theme, which is what we like.
And you also call it specifically, Gargi, you see opportunity what you call lovable laggards. What is that? What does that mean, Gargi, exactly? Which sectors fit that criteria?
Yeah, so, when we came out with our year ahead outlook, which was back in December, the two areas that we felt that were most likely to catch up to the rest of the market were financials and healthcare. And the reason that we chose each of them were a little bit different. For financials, it was very much around that pro-cyclical move. It was around our expectation that the yield curve may steepen a little bit or at least not continue to flatten. For healthcare, it was very much about the expectations of growth. Obviously, the first couple of months of the year, we've seen healthcare do very well, keep up with the S&P financials as well. We still do think, actually, there's a little bit more room to run there, especially if we continue to believe that a steepening or at least a lack of flattening is in the stores for us for the next couple of months as well. So the lovable laggards, areas that investors haven't really reached into in terms of flows, or when we look at flows, it's what reveals to us as really under-owned, continue to be that healthcare and financials and the growth dynamics, earnings growth dynamics, especially for healthcare, sort of beginning to turn in the second quarter or so of this year.
Gargi, how closely, we were just talking about rate cuts and how many are happening and when they're happening. One would have to think that one of the groups where it really does matter is in the financials. Or do you think that relationship is less important than it used to be because the financials have gotten somewhat more diversified?
Yeah, number one, they've gotten more diversified. I would argue that they're a lot more higher quality, at least banks and insurers are. However, having said all of that, if there's any reason for us to believe, and I know, I think Brian was talking about this earlier in terms of what we may or may not get from the Fed, if there's any reason for us to believe that the next move from them is not a cut, whenever that comes, but if there's any reason for us to believe that the next move is not a cut, I think that can certainly, sort of hamper some excitement that we've had around financials. But for now, the two ways in which we can, with the quality being the core, quality and large cap, we look at the tickers QUAL and IWY as the core of your portfolio. I think the satellite, if you will, can still be the healthcare and financial sectors based on our view of the Fed and our view on earnings.
And Gargi, I get you out of here on this kind of a broader question, Gargi. With rates steady and corporate earnings season, it's largely behind us. What do you think, Gargi, a potential catalyst is for the market in kind of just the near intermediate term here, next few months?
I think a couple of things. Number one, I think we have so far seen growth expectations, whether they come from sort of the strength we're seeing on the consumer side, on the consumer balance sheet side, whether it comes to jobs, all of that has been better than expected, right? So if that changes, if a dynamic around the labor market strength, or the consumer strength begins to change, I think that's certainly something that can be a catalyst for a pullback in the market. Another, of course, is what you guys were discussing before, which is around the reaction function from the Fed. So far, the market still expects that there's going to be approximately 3 cuts. I think if we get inflation data that questions that view, if we get sustained inflation rates, not one print in January or one print in February, but if we get sustained super core, which is of course the core X shelter that continues to move higher, I think that can be something that will take a little bit of time for the market to digest. Look, so far, higher yields have not hampered equities, which is great because higher yields have come about because of an expectation of higher growth. To the extent we move away from that and higher yields is as a result of expectation of inflation but not growth, I think that does bring some concern to equity investors, at least in the short term. In the longer term, I think the fundamentals look very solid, especially for quality and growth companies.